Hello and welcome. You're watching News9. I'm Shweta Kothari. This is Business Plus. We're bringing you stories from the world of business, policy and economy. To my left is Suyash Maheshwari. Suyash, good afternoon.
Good afternoon, Shweta.
Market ending in green and, starting in red and ending in red, of course.
Yes, Shweta. So the Indian markets have extended their losing streak to 2 sessions now, and the market opened lower by about 0.5% or so, where we saw Nifty even slipping below the 19,400 level in the morning trade, and taking support somewhere around the 19,300 mark. Now, in the afternoon trade, Shweta, the benchmarks were able to pair those losses, and in fact, I think one of the things that bulls will take, from the today's session was that the markets ended near the day's high. Now, despite that, the markets still ended about 0.4% lower in today's trade. At close, Sensex was down 286 points, and it closed above the 65,200 levels, whereas Nifty rescaled the 19,400 mark and closed marginally above it. Now the broader markets, Shweta, which we have seen have been outperforming for the past many months, came under selling pressure today. Nifty mid cap and the small cap indices both corrected by over 1% in today's trade. Now if you are also looking at the volatility index, the India VIX slipped by about 1.63% in today's trade, and it slipped below the 12 mark, which suggests that the volatility going forward is expected to be lower. Okay. Although with RBI's MPC coming forward, I don't really understand why the volatility will fall. Perhaps Ambareesh could enlighten us on that. Now let's also talk about the sectors. Now, barring FMCG and the IT pack, most sectors ended today's session in the red. Now, among the sectors which fell over 1% was Nifty Auto, which corrected by about 1.3%, Nifty Financial Services, which corrected about 1.27%, Nifty Media, which fell by 1.72%, Nifty Metal, which also corrected by about 1.06%, Nifty PSU Bank, Shweta, which if you remember yesterday surged by about 2.5%, saw some correction today amid a broad-based selling in the banking pack, and it corrected by 2.83% in today's trade. Realty was another one which corrected by over 1% in today's trade. Now, I also want to touch specifically on the banking pack. Most stocks except, guess what, HDFC Bank ended today's session in the red. HDFC Bank was the only constituent stock in the Nifty banking index that was able to post some gains, and it posted gains of about 1.5%. Rest, all of them saw heavy profit booking led by a sell-off in PSU banks, and the index has slipped below the 44,000 levels for the very first time since September 1. So this could be a major drag for the index going forward. 44,200 was being looked at as an essential or a make or break level for the index. The index did slip below that, and it settled below the 44,000 mark. So perhaps there is some pressures remaining for the
Okay, let's understand what those pressures are. Ambareesh Baliga, independent markets expert, joining us on the show. Ambareesh, thanks very much for taking time out. Good to have you back, sir. We've seen a sharp rally at the start of the month, and now we're looking at a sharp fall for 2 consecutive trading sessions now. What are you making of this consolidation? Is the worst over? Hopefully there'll be recovery now. Green shoots from next week onward. When does this onslaught ends?
I doubt whether we can call this green shoots because the way I see it is possibly this is the beginning of a correction, which I've been talking about for a while. And every time we saw that the markets were taking very good support at that 19,500, 600 levels and moving back. But now, since that is broken decently, decisively, despite the sort of bounce back which we have seen intraday today from the lower levels, I think it was a very spirited bounce back. But I doubt whether this bounce back can really last too long and go beyond that 19,500, 600 levels for that to sustain. Because there are, a decent number of red flags around, right from the oil prices, the way they have been moving, expected Fed hike before the end of the calendar year. And again, as far as the earnings are concerned, Q2 earnings should be starting within a week. And again, out there, the expectations, have been decently high looking at the way the run-up we have seen in the markets for the last 4-5 months. So there could be a room for disappointment, and with that, I think that could be another reason for the markets to correct. And last but not the least, I think the elections, I mean, both assembly as well as general elections next year. I mean, as we are getting closer to that, that should add to volatility and some amount of caution. I mean, although people may have a view that the same government will come back, post the Lok Sabha elections. But whatever said and done, elections means certain amount of uncertainty. So I think because of which we could see more volatility in the markets. So I really don't see too much of an upside for the market. In fact, I mean, if you ask me whether the markets will see 18,500 first or 20,000 first, I would say 18,500 now.
All right,
Wow.
and of course that's a very significant commentary. But what's your near-term support for Nifty as it breached 19,500 as of today? What's the near-term support levels you're looking at?
I mean, if I could also jump in here, October has been a historically, a good month for the markets. And do you expect that 18,500 to come this month, or perhaps this is a, a longer term outlook?
The timeline, perhaps, if you can give on that 18,500.
18,500 this month because 18,800, 18,900 is again another decently good support technically. So if that gets broken, yes, I think we'll see 18,500 levels or below immediately post that. Like just like the way we are talking about 19,500, 600 for a while. I mean, till that was broken, I mean, it took a while for that to be broken. But then once that was broken, we have seen a sharp correction from there. So similarly, we'll have to see as to how long it holds on to that 18,800 mark.
Okay, and what's the timeline you're giving it at the moment? How long should one wait and watch out for that, 19,000 mark to be breached or 18,500 to come in before they can start jumping the queue once again?
The way I see it is we should see that possibly in a month and a half. Basically, because like I said, earnings season anyway is starting off, and along with that, if we see the oil, going closer to 100 or crossing that, I think that could be a major trigger for the markets to go down.
Now,
Right.
Mr.
That's a very
Baliga,
major sort
Yeah.
of commentary for all those who are watching markets at the moment. I mean, so far, one of the sharpest commentaries I've seen in the past 1 month from Ambareesh Baliga as to whether it's going to be above 20,000 first or below 18,500 first.
that's a big drawdown. I mean,
Big drawdown,
what are your
absolutely.
expectations from the Q2 earnings? Will that be a disappointment and perhaps pull the index to those kind of levels?
That could be like one of the reasons, and we could see stock-specific movements in that. Like I said, I mean the way the markets had run up, and with the Q1 earnings which were decent, the expectations for Q2 have been moved up by the analysts. So whenever your expectations have gone up and the performance is not as per that, so that leads to a disappointment, and I see a decent amount of disappointment possibly happening in Q2 because of that.
Any particular sectors that could disappoint?
Sector-wise, clearly, I think metals will see disappointment. IT could underperform anyway. That expectation is there, but once it is out in black and white, we could see a further correction in the IT space. So I think these two spaces need to be looked at. And at the same time, if you're talking of the export sector, I mean, the sectors which are dependent decently on exports, I think that is where we have seen some amount of slowdown. So we could see underperformance also from there.
All right. I have two questions for you. Since you talked about exports, Ambareesh, I want to first understand the government is very upbeat on exports, and Commerce Minister has time and again said exports are picking up, and you can see it in the way of narrowing, current account deficit. Do you see exports picking up in the next, month or so?
See, the thing is, we may like to export, and there could be decent amount of SOPs being given by the government. But then, if the global economy is not really performing, it's a bit difficult for you to keep pushing exports. So, if you're talking from a short to medium term perspective, I see the exports, not really doing too well. And again, if you're talking of IT, that's clearly seen out there because discretionary spends are being controlled, and that is affecting the IT space. So it's similar across, the other your goods which are being exported. So I think if you're talking of the next 2 to 3 quarters, we could see some amount of slowdown. But I think post that we should see some a decent up move from there. But whatever said and done, I mean, although I may look bearish, look very cautious, but then if you're talking of Indian economy over a longer term, if you're talking of the next 5-10 years, I think we will clearly be the brightest spot. Globally, and this fall, which I'm talking about, should be utilized to buy and completely fill up your portfolio.
Absolutely. I was about to come to that. So my next question, what should the retail investors do at the moment? Should they wait and watch out? Should they be on the sideline, not jump in?
You are expecting a 5% correction.
Absolutely.
In markets.
Considering the amount of correction that you're expecting over a very short span of time, what should retail investors do?
See, I mean, most of the retail investors would have bought mid cap and small caps in huge quantities in the last couple of months because that is what was performing. So if you're sitting on decent amount of profits, I think it's time to book out because the mid cap index has just started falling. So most of the stocks would still be in profits. So book profits. Hold that cash for the markets to correct, and then possibly buy again at lower levels. But when you buy, one should buy decent number of large cap and blue chips also, because that is what gives you that stability in the portfolio.
Now, Mr. Baliga, I also wanted to touch upon mid caps, and since now you have mentioned that there could be correction, the overall breadth of the mid cap spaces has also been reducing. The less and less number of shares are participating in that rally that we have seen playing out, over the course of the last 6-7 months or so. So perhaps maybe now is the time to focus on large caps, book profits. I'm asking this because a lot of retail investors have participated, as you mentioned, and a lot of mutual funds, mid cap oriented funds have seen a lot of inflows lately from retail participants.
No, because see, typically what happens is whichever part of the market performs or moves up, that is where the money flows in. And what we have seen in the past 5-6 months is that the small cap and the mid caps have actually become multi-baggers. Some of them have become multi-baggers in the last few months. So it's quite natural that when people see profits there, they blindly put in. I don't know how many of the retail investors really look at the fundamentals. Most of them look at momentum and invest.
I mean, Shweta, is a classic case of when your taxi driver starts talking about the stocks, it's perhaps time to exit the market. So I think that's playing out in the mid cap.
Is it? I would say it's the other way around. When your taxi drivers start talking about it, perhaps it's time to enter the market, because, well, as we have seen in the past 1 month or so, the extreme volatility, the highs and lows that we've seen in the market, that is when you expect a common citizen to keep a close watch and enter the market.
But that's also when they can get stuck, because if you're trying to buy that in that rally, you may end up buying it at a higher level, and there is a sudden crash, and retail investors often turn jittery, and perhaps they tend to sit and wait and see for some sort of a pullback in the stock.
Do you know, the September rally has challenged a lot of my held notions about markets. The moment you'd say, okay, this is it, it's not going up further from here, markets touch 2,000, 20,000, and then beyond 20,000.
And then they fall 500 points.
And then they fall 500 points all of a sudden. So all my previously held notions were in a way challenged in the month of September.
Certainly, it looks like so, and the markets have been, seen extreme bouts of volatility playing out. And Mr. Baliga, what's your view on the banking space? Now, banking space has been a major drag on the headliners lately. In the last couple of days, I think it was the correction that we were seeing playing out in HDFC Bank and ICICI Bank that was pulling down the headliners. What's your outlook, especially that at least from a technical standpoint, we have broken that support level of 44,200 levels?
No, banking space overall, I'm not too bullish, but at the same time, I'm not bearish. I will not buy fresh. And any upside, especially in the PSU banking space, possibly I'll utilize to exit the holdings which I have. Because the PSU banking space, from a level where people had given up on the sector or the stocks, these stocks were like rediscovered about a year and a half back. And after that, we've seen an extremely good move, basically because most of the balance sheets have been cleaned up. They showed, record profits in the last 4 quarters. So clearly, the stocks had to move, and they have decently well. But from here on, I don't see the next leg of the rally, basically because one, the story is already known. And if you're talking of NIMs, the net interest margins, I think that's more or less peaked out for most of the banks in Q4 and the rest of the banks in Q1. Clearly, I think in Q2, this will be confirmed that the NIMs have started to correct. So when people see that and the performance may not be in line with what we have seen in the last 2 to 3 quarters, we should start seeing further correction in the banking space. But then I think the PSU banks will correct more than the private sector banks because they are the ones which have really done well in the past 6 months.
So what's your expectation on the private banking pack as you, are the valuations looking any reasonable now, given that we have seen a fair bit of correction in the space?
Yeah, in the private sector banks, one of them which I will possibly look to buy would be HDFC Bank. But again, I'm still waiting for a further correction, maybe closer to about 1425 or so. I think that's the level to start buying HDFC Bank. But again, not for a bump up. I think it will be at least about 2 to 3 quarters before we start seeing a decent move in HDFC Bank because whatever actions this management is taking, the CEO is taking, I think it'll take a while for it to really flow. Show up on the balance sheet. So it will be maybe a 3 to 4 quarters sort of a hold. Only if one has patience of that, should one buy at about 1425 levels.
All right, Ambareesh, let's also quickly take a look at some of the stocks that we are tracking, specific actions on stocks this afternoon.
Yes, Shweta. So let's start with the gainers first. Now, Adani Enterprises was a top gainer in today's session. It rallied over 3%. Now, this was on the back of IHC picking a stake of, worth 153 crores or 163 crores as per yesterday's closing. They have bought a stake from undisclosed buyer. The stake of about 0.06%, taking the total stake now to 5.04%. Now, if you remember last week, IHC selling stake in 2 of Adani Group companies was a major dampener for the stock, and today's reassurance that Adani is perhaps not going to lose a marquee player in IHC has boosted not only Adani Enterprises stock but also stocks of other Adani Group companies. And we saw, all of them post significant gains in the intraday trade, although there was some profit booking that took place at higher levels. Now, another stock among the blue chips that rallied today was Nestle. Nestle was up about 3% as well. Now, the company has said that it is considering its first ever stock split. And if you remember, Shweta, the stock of Nestle currently trades at about 22,900 levels or so. So a stock split will perhaps enable retail participants to also participate in that rally, because 22,900 is a very high price tag for the retail participants who have a small capital to begin with in the first place. So a stock split would overall improve the liquidity in the stock, will also help the company diversify its portfolio base. So perhaps that is playing out in the stock, and as a result we saw a 3% gain. Another reason is that Nestle is also considering a second interim dividend with its Q2 earnings that come out on October 19. Now, another stock that gained in today's session was Eicher Motors. Now, Eicher Motors has been under pressure for quite a while now. The stock is perhaps seeing some sort of a technical pullback. If you remember, the stock had corrected by about 3% or so yesterday after the September sales saw a degrowth, right. And the sales of Royal Enfield also declined about 3% year on year. I think there is some technical pullback playing out in Eicher, considering that other two-wheelers have posted decent gains of about 2 to 3%, whereas Eicher Motor in the last 1 month has been trading flat. Now, another bank we have been talking about, it was HDFC Bank. Now, HDFC Bank was a sole gainer in the Nifty banking space. The lender has now announced a restructuring of its top management. Now, this is the first restructuring post HDFC merger with parent company HDFC back in July, and it is also only the second restructuring since Shashidhar Jagdishan took over from Aditya Puri about back in October 2020. HUL was also another stock that gained today. It rose by over 1.5% after CLSA updated the stock to buy and raise the target price to 3,135, implying an upside of about 27% from the today's closing. Among the losers, Shweta, was Axis Bank. The stock snapped its 4-day winning streak to decline by over 4.5% in today's trade. Now I couldn't find any particular reason why the stock fell, although there was a report from Hindu Business Line which suggested yesterday that perhaps Axis Bank could be looking to raise funds to the tune of 10,000 crore via QIP, although Axis Bank did come out today and said that the report is speculative and factually incorrect. So it played a dampener that the bank is not looking to raise funds. And SBI was also among the losers. It fell about 3%. Now, SBI is one of the only stocks, actually it's one of the few stocks in the PSU banking space that even the investors are still extremely bullish on. It has about 47 buy calls, which is the highest among the Nifty PSU bank constituents. IndusInd Bank also saw a decline of about 2.33% despite the company reporting steady growth business in its business update in Q2. Bajaj Auto saw a correction of about 2.2%. So these were some of the stocks that were in the news today.
All right, those are top losers and gainers, of course, for the Wednesday's trading session. Mr. Baliga, thanks very much, sir, for taking time out. Thank you for being with us. We'll get you back. We hope to get you back really very soon. To you too, Suyash, thank you so much for joining in. And let's move on now. Are Indian startups finally seeing green shoots of recovery? That's the question we are asking after a string of valuation markdowns in the Indian startup ecosystem from the start of the year. US-based investor Fidelit has increased the face value of its investment in e-commerce firm Meesho by 14.3% to $43.24 million as of July, bringing the company's valuation to around $5 billion. Just a few days before this, US headquartered asset management firm Baron Capital also marked the value of its stake in food delivery platform Swiggy up from 30 to up to 33.9% from 31st of March to $8.54 billion. Does this mean that startups in India are recovering? There is better valuations and more companies are looking back to invest in Indian startups. To discuss that, we have Barnik Chitran Maitra joining us on the broadcast. Also, my colleague Krishna Kumar joining us here in the Newsline studio. Let me quickly get in Barnik first. Barnik, good afternoon. Thank you so much for taking time out. Is the worst over for Indian startups from what we are looking at the moment? There seems to be more interest towards better investments that have not come in by the way of a very prolonged funding winter.
Yeah, so I think in short, I think the worst may not still be over. So let's look at the facts of some of these valuation markups, right? Fidelity has marked Meesho back to the level it was actually before its own valuation markdown a quarter back, right? So pretty much Meesho is back at where they were with Fidelity nearly 6 months back. Similarly, Swiggy's markup is pretty close to what Invesco, another investor, values them, which was still at around 50% below their peak valuation. Now, it's interesting to note that a lot of these markups have been driven by pure profitability. So Meesho is now the only true horizontal e-commerce platform which is PAT positive. Swiggy has also declared profitability on its food delivery business and has cut down its burn from nearly $50 million to under 20 million. So if you're in the camp where you're cutting your burn and you're getting to profitability, maybe the startup winter is turning to spring. But if you're still burning a lot of capital and don't have a path to profitability, it's going to continue to be a long, hard funding winter for you if you're in that camp of cash burn.
All right. And the game of unicorn and soonicorn and the fact that we keep celebrating, India got its first unicorn very late in September of 2023 by the way of Zepto. Are there more unicorns in the pipeline? Is that still a markup that we should be celebrating? Is it still significant, or have we sort of shifted the conversation? There's been a structural shift to beyond valuation to what you're bringing to the table, the value that you're adding for your customers.
Yeah, I think there have been two funding celebrations recently. One is the Zepto funding and the other is the Perfios funding. I think we should move away as an ecosystem from celebrating unicorns but celebrating startups which get profitability at scale, right? I think that to me is the more important milestone. Even in more mature startup markets like the US, startups are really celebrated when they go public, which you can only go if you're profitable. So I think we are now a mature ecosystem. We can't claim to be an emerging startup ecosystem anymore. We should celebrate successful, profitable public sector companies or public startups who manage to go public, and not just celebrate startups who've hit some valuation milestones, which we've now seen are very, very volatile, and you can get marked down up to 60 to 80%, as has happened with some of the biggest players in the ecosystem.
Right. Krishna, interesting. There has to be a shift. I think Barnik is essentially referring to a shift that was long time coming. It essentially boils down to your business model and what you have to offer to your customers. It's no more about a markup or a markdown in valuation. It's about the actual business, how that business is doing. Perhaps that's one of the lessons that we have drawn from the prolonged funding winter.
Definitely. And if you're talking about the markups per se, the month of May this year was the month in which literally every single big startup in India got marked down its valuation. Ola got a knockdown on its valuation, Byju's obviously because of all its troubles, and tons of others in the month of May. But what we did witness in the month of August, 3 months down the line, was a series of markups. And as Barnik was talking about, these markups sort of bringing those knocked down startups to their original valuations. But they were also accompanied by Shweta cost-cutting measures by literally every single startup which has seen a markup. You've seen Swiggy slash jobs. You've seen the volume of business and revenues grow up, in the January to August period. So there is, I would say, a sense of confidence. And I want to check this with Barnik as well. Barnik, if I were to ask you, you've seen these startups cut costs, get more serious about profitability. At the same time, when the overall confidence in the Indian economy, the Indian market remains high, do you think it's a combination of these factors which are sort of pointing to a turnaround in things for startups, be it in terms of valuation markups or in terms of availability of funding?
No, I think, to be fair, early stage funding has been reasonably robust already for a couple of quarters, right? So the funding winter has hit companies hardest who've actually raised several $100 million and have no path to profitability. So I think the good news for the ecosystem is that profit is no longer a dirty word. I think people are focusing on it and building sustainable companies. I personally believe that this funding winter is going to teach founders to be far more frugal on spending and building far more scalable models. So while I think it is cautiously optimistic to assume that the worst is behind several startups, I think we will still see a few more quarters of spectacular markdowns, maybe some startups going bust, but backed by some startups which are doing better, raising capital and marking up. One big metric I look for personally is public listing. If you've looked at the news over the past 3-4 quarters, several startups have claimed that they are in plans to go public. Actually, no one has really gone public. So the next time we actually see a few startups actually go public, that's when we know that the worst is actually behind us. And I'm keenly observing few startups who actually not only announce plans, but actually go the full distance and go public.
Right. And going public, all the more important, Barnik, because a lot of numbers and figures that come from these startups which are not public, we don't know how much and how far we can trust them as far as profitability is concerned. Specifically with Byju's, there's been a question mark on what the financials of the company are because they've been unaudited for a while. Given the opaque structure around which profitability is reported, how do you actually believe these numbers?
So listen, I think the best sunshine is the best disinfectant, and in this environment or in this ecosystem, public markets is the sunshine which actually shines on startups. So I think it's very hard to believe any numbers because I don't think the ecosystem has covered itself with glory when it comes to corporate governance and meeting ethics. So for me, I think any numbers we see from private markets, we have to not only take with a grain of salt, but with a bucket of salt. I would far more trust numbers of publicly listed companies which have stricter disclosure norms, which have regulators breathing down their neck. And that's where we see real numbers. Everything else which gets reported either on accounts which have been unaudited or claims which people make when they raise funding, I would take very, very, I would say cautiously and only believe numbers of companies who've gone public.
friend of Barnik making it sound like data from China when it comes to startups reporting their profitability numbers. But the one thing I want to ask you is that one very clear thing that emerges, especially from Byju's and other things that we've witnessed in the startup ecosystem, is that high cash burn business models are certainly under stress. There's a lot of questions surrounding it, be it in terms of the initial investment and the continuous rounds of investment required to keep those businesses running. So in that sense, does all this churn mean that high cash burn business models go out of fashion, and we're looking at businesses with lower cash burn?
So I think structurally, investors have now very clearly made the distinction between businesses which cash burn versus businesses which should not be, right? So if you're building a business model disruption where you're trying to create a new business model, I think the expectation from investors is that you get to unit economics profitable within a couple of years and not wait for 6-7 years. I think the only leeway will be given for companies who are building deep and fundamental technology, where I think there will be far more patience for longer cash burns. So while there will continue to be patience for longer periods of cash burns, but I think the scale of cash burns and the leeway the whole ecosystem had in terms of burning hundreds of millions of dollars is likely not going to continue for the next few quarters. That said, there may be yet another round of crazy valuation, crazy funding. That may be around the corner when the Fed starts again reducing its rates. But again, for now, it's very clear that cash burn business models are not getting funded. You can burn, but you cannot burn a lot. I think you have to be far more careful about burning. The days of sponsoring World Cups and the Indian cricket team, I think, are behind a lot of startups. I think that's not going to get encouraged anymore by startups. And some of these excesses being coming down is the right thing for the ecosystem. I think the ecosystem has to demonstrate that it builds responsible companies which are sustainable and scalable companies and which can be taken public in a matter of years. To be fair, even today, and again, I may be the only detractor in the full ecosystem, we are still yet to see the super profitable publicly listed startup, right? Unlike we don't see any Googles, we don't see any Facebooks.
Okay,
so that's
hold that thought, Barnik. That's what I want to ask. In a low profitability environment, do publicly listed companies have a better chance at surviving and, of course, prospering? Because at the end of the day, they are judged quarter to quarter.
So if you are profitable and if you have a business model which scales sustainably, being public is not a bad thing. You should understand why founders and investors love private capital, because it reduces the amount of scrutiny. It does not put them on a quarter by quarter treadmill, right? Now, the downside of that is effectively private capital can go away. As we've seen, you can be subject to severe volatility with valuation markdowns. I think the other path is to go public, but if you go public, you have to be damn sure of your business model, the fact that it is not only profitable, but also scaling every quarter. I think founders who are willing to explore public markets, and I'm increasingly seeing a lot of founders who are exploring ideas like SME Exchange, the BSE SME Exchange, to list primary capital from the public market as an IPO and not use venture capital. You have to be ready to face the scrutiny and be on a treadmill where the speed of the treadmill is increasing every quarter, right? So if you're ready to face that music, I think the public markets is not a bad draw. But remember, a lot of companies don't go that route because they're structurally either not profitable or not ready to be scrutinized at the level you will be when you go to public markets.
All right.
All right, Barnik, thank you so much for taking time out this afternoon. Thank you for speaking to News 9.
Thank you. Thanks a lot, Shweta. Thanks, Krishna. Take care.
See you. Bye-bye.
Shifting focus now, in the July-September quarter, for the first time in India, sales of high-end homes priced above 1 crore rupees have surpassed demand in the affordable segment or over-affordable segment, which is priced below 50 lakh rupees. This, according to a report by real estate consultancy Knight & Frank. The India Real Estate Q3 2023 report released on Wednesday highlighted that the number of homes sold in India during the quarter reached a 6-year high, with the sale of 82,612 units. This figure was 12% higher than the 73,600 units sold in the corresponding quarter of previous year. Essentially, Krishna, hinting at the fact that there is more demand now for high-end housing as compared to affordable housing. What's happening here? Right.
As you rightly pointed out, before we get to that, it is 12% growth for the July to September quarter. Overall, all homes, as you're rightly pointing out, that's why we begin there. Good growth, and you're talking about growth at a time when interest rates are high, the home prices are high. So it's good to know that the overall home sales in India is growing up. It's at a 6-year high. More importantly, the July to September growth is at a 6-year high for quarters, the same quarter in the past 6 years. In that growth, what has happened, Shweta, for the first time ever, demand for high-end homes have beaten the demand for affordable housing. For example, in the year 2018, the market share of affordable housing segment in India's housing market was 54%, more than half. Guess where it is right now? Just 29%. And that's because there has been a 35% growth in homes priced above 1 crore rupees.
So is it the prices of home, is it the inflation that of real estate that's a problem, or are people actually spending up higher? I mean, which of the two is playing up? Is it the both of them together, or is it one over the either?
Right. It's a combination of both, but the fact of the matter is that those factors seem to not corroborate with the data that we're talking about. If home prices are high, if interest rates are high, demand for all homes should be down. Right. And that's not the case. We've sold more homes in the July to September quarter this year than in the previous quarter, which means the demand for homes on the whole, if you take it, it's gone up by 12%, despite the high home prices, despite the high interest rate cycle that we're in. So there I can't infer anything, because all kinds of home buyers have ignored these signs and have just gone ahead and bought houses. But what is interesting in that entire buying, usually it should have been pushed up by a maximum demand for affordable housing. That increase in home sales. But what has happened this time around, and that's for the first time ever, from the real estate consultancy like Knight Frank, which has been tracking the market so long, is that the demand for affordable housing is lower than the demand growth for premium housing. And when I say premium housing, it's 50 lakh to 1 crore rupees is the first set of premium housing, which has witnessed the highest sales in terms of number of units in the July to September quarter. And in terms of the highest growth, 35% growth in demand for homes priced 1 crore rupee plus. So therein lies the delta. To be really honest, we'll have to wait and watch how long it can sustain itself, because let's face it, the requirement for affordable housing in this country hasn't gone down. What has gone down is sales for the July to September quarter. So it's very wrong to jump at conclusions over one quarter's data, but it is an interesting trend that is peaking in the housing market.
Very interesting trend. I wonder whether it'll ever go down. I think the demand for high-end houses is only going to increase. I mean, that's what the trend is suggesting us at the moment. Krishna, thank you so much for that piece of news. But shifting focus now to the NPS versus OPS debate that continues. The new pension versus the old pension. Remember, employees of the central and state governments from across the country on Sunday gathered at Ramleela Maidan to demand the restoration of the old pension scheme. In the latest in the matter, states are saying that they will settle for lower but assured pension. At present, while the government contributes 14% under NPS, an employee contributes 10% of his salary plus the DA. My colleague Karthik Malhotra walking into the studio to explain to us what this entire contention is all about and what exactly are states saying. Firstly, break it down for us. What is the new pension scheme about, and what is the old pension scheme about? Why are people, bank employees and employees of all other central and state banks, or central and state government rather, asking for OPS to be restored?
Sure. So, Shweta, there are two aspects to this. One aspect, of course, is pure political, and that is something that we saw play out at Ramleela Maidan over the weekend. And the other aspect is far more fundamentally economic in nature, right? Let's just look at the two. You've spoken about OPS and NPS. Let's just try to break it down and just run through the graphics as they appear. Now, what is the old pension scheme and what is the new pension scheme? I think very simply put, the old pension scheme has got a fixed return. It is something which gives you a guaranteed benefit and is something which the government is liable to pay. Right. Which are the states where we actually see this debate really raging right now? Which are the states which are demanding the old pension scheme to come back? It is the capital of the country, Delhi. You've got Rajasthan. In addition to that, you've got a state like Chhattisgarh. You've got a state like Punjab. You've got a state like Jharkhand. And you've got a total of these 6 states. And if you look at the pattern here emerging from these 6 states, very simply put, the pattern is, and you've got Himachal Pradesh. The pattern very clearly suggests that these are states which either have, look at Delhi and Punjab, they either have the Aam Aadmi Party government ruling, or you've got states like Himachal Pradesh, like Rajasthan, like Chhattisgarh, which have a Congress government, or you have a state like Jharkhand, which actually has a Congress-supported JMM government in power. Now, let's just try and break down the OPS versus NPS debate, and where is this debate really coming from? Now, the old pension scheme has got something which is called the defined benefit. What is the defined benefit? This defined benefit is the benefit to the employee, which is a guaranteed return. What is this guaranteed return? This guaranteed return is 50% of the last drawn salary. Now, where is the salary coming from? The salary is coming, or this pension rather, is coming from the government. So, it becomes a clear-cut liability for the government. Who gets this old pension scheme? Anybody who was an employee in the central or state government prior to 1st Jan 2004 is liable to get the old pension scheme. The rules changed for the new pension scheme. Now, look at the contrasting difference. Instead of a defined benefit, the new pension scheme offers a defined contribution. We'll come to what this contribution is. Instead of a guaranteed return, the new pension scheme offers a market-linked return. Now, the 50% of the last drawn salary in OPS is no longer valid. It is actually a larger corpus being created, which then funds this new pension. Now, while it continues to be a government liability, it is a reduced liability for the government, because it's not just the liability of the government alone to deliver this pension, but rather the market and the investments made via this corpus to fund its own pension. And this scheme, of course, is valid for employees who joined the workforce in the central or state government after 1st of Jan 2004. Now, let's look at the makeup of this corpus. This corpus consists of actually two critical components. One, of course, is the employee's own contribution. The employee contribution is 10% of the salary, of the basic salary, whereas the government's contribution is about 14% of the salary. Put together, these two create a large corpus over time. This entire corpus then becomes the pension corpus. Now, what are the risks to this pension corpus? There are three prevailing risks to this. Number one, this pension corpus is going to be used to purchase an annuity. This annuity is a market-linked financial plan which gives you year-on-year returns. Now, there is, of course, one risk, and that is the interest rate risk. There is going to be a prevailing interest rate at the time of your retirement. That could be a high interest rate giving you more pension, or a low interest rate where your annuity actually reduces the amount of monthly income that you draw. And then the third, of course, is the life expectancy. Now, for somebody who's going to live longer, obviously there are greater benefits that accrue by way of this corpus being invested in an annuity. But if you were to cop it, unfortunately, 5 years after retirement or so, then that money, of course, has gone back to the government, so you don't get any benefit from it. Now, overall, if you look at it, there is this larger question about the government's liability. And the government's liability, if states were to revert to the old pension scheme, the government's liability goes up 4.5 times as compared to the new pension scheme. Okay. So, the new pension scheme, let's say in the year 2050, is going to cost the government about 4 lakh crore rupees. Now, what is this government cost? We'll come to. But if it costs the government 4 lakh crore rupees to opt for the new pension scheme, then if states were to push back and revert to the old pension scheme, the liability goes up 4.5 times to about 17 lakh crore rupees. Now, that, of course, is going to burn a hole in the pocket of the government by way of the fiscal deficit. And that is something that India will be able to ill afford.
Right. In all of this, I think one of my questions remain, what is exactly the problem with new pension scheme? Why are government employees protesting?
Very simply put, I think the protest right now emerges from the fact that you joined a government organization and you took a government job because you wanted to retire.
So you want surety.
You want assured income in your hands because that is what you signed up for. But the government is now putting a brave front forward and saying that we can afford it today. We won't be able to afford it 20 years, 30 years later. So if you are unable to afford it going forward, then it's better to go for an internationally designed model of the new pension scheme where the upside of your return could be very high. But then there is this risk of a downside if you happen to be retiring at a time when your investments are crashing. So that is the main conflict. Now, is there a hybrid solution possible? To my mind, yes, and I think that is the middle ground that will have to be taken. That middle ground is that you create a hybrid option where it is not 50% of your last drawn salary which goes as your pension, but rather a reduced maybe 25%, 30%, 40%, whatever is an assured income that the government commits to, which is taking a leaf from the book of the old pension scheme. and the balance could be funded through investments made via what we call this corpus creation by contribution of the employees and the government. So I believe there needs to be a hybrid model where there is contribution by the employees, there is contribution which is part of the CTC by the government, there is a corpus that gets created. While this corpus gets invested to give market-linked returns, there could be maybe a reduced yet an assured, not 50%, but something below 50% or 40%, 35% sort of an arrangement which becomes an assured money, and the rest of it is based on the vagaries of the market.
And that is, of course, what state governments are saying.
State governments are saying we are willing to sort of negotiate this. We are willing to not revert to the old pension scheme as long as the new pension scheme has some element of defined guarantee, defined return, as opposed to it being completely dependent on the vagaries of the market.
All right, so there's this ongoing raging debate about NPS versus OPS continues. We tried breaking it all down for you as to which is more preferential, the economics of it as well as the politics of it. We'll keep bringing those updates on Newsline. Thank you very much for watching. Delhi has the fastest growing metro network among G20 nations. From 6 stations in 2002, it today has 286 stations. Reliability, cleanliness and affordability have set the template for other Indian metros. The architect of this modern-day world-class marvel is E. Sridharan. Watch the extraordinary life of Metro Man E. Sridharan streaming now on Newsline Plus. Download now.
ChatGPT. It can generate codes and human-like responses through text, write stories, and do a lot more.
I work in a newsroom with anchors, researchers and scriptwriters, graphic artists, producers, video editors, camera crew. But does a newsroom really need them today?
All of us have to think about unique and distinctive value addition that cannot be automated or repeated or replaced by a machine.
ChatGPT may kill many companies.
A human has to be in the loop with an ability to control this.
Dark Side of the Boom. Streaming now.
मैं तो चलिया विदेश
No, it's not a story of diversity in India. It's about a burning desire to leave the country, whatever it takes.